Imagine you wake up tomorrow and the news is screaming that $5 trillion was wiped out of the stock market in a single day. You check your portfolio and you've personally lost $50,000. But where did that money actually go? Did someone steal it? Is it sitting in a bank account in Switzerland? Is it under a billionaire's mattress? The answer is the most important lesson you will ever learn about the nature of wealth. That money never existed in the first place. Welcome back to EconDepth Insiders. Today, we are pulling back the curtain on the greatest illusion in the financial world. We are going to find out exactly where your money goes during a market crash, why market cap is a fairy tale, and why the person who understands this is the only one who survives a recession. To understand a crash, you first have to understand what a price actually is. Most people think the price of a stock or a house is like a label on a can of soup, fixed and solid. But in economics, a price is nothing more than a guess. It is a temporary agreement between one person willing to buy and one person willing to sell right now. Think about it this way. Imagine you own a rare trading card. Yesterday, someone offered you $1,000 for it. You didn't sell it, but in your head, you felt $1,000 richer. Today, that same person hears a rumor the card is a fake and says they'll only give you $10. You just lost $990. But did $990 leave your pocket? No. Did it go into the other person's pocket? No. The $990 simply evaporated because the collective guess about the future changed. This is exactly what happens in a stock market crash. When the news says trillions were lost, they are talking about market capitalization. If a company has 1 million shares and the last share sold for $100, we say the company is worth $100 million. But if the next person is only willing to pay $50, the entire company is suddenly worth $50 million. $50 million didn't move anywhere. It just vanished into money heaven because the collective guess about the future changed. But here is the O factor. While most people's paper wealth is evaporating, a small group of people is actually getting richer. This is where the money redistributes. First, there are the short sellers. These are the people who bet against the market. In 2026, as the debt bubble we discussed in video 12 starts to leak, these players are using sophisticated tools to profit from the decline. When you lose $100 on a falling stock, a short seller might be making $100. They aren't taking your money directly. They're winning a side bet that the market would fail. Second, there is the flight to safety. When the guess about stocks turns negative, the real money, the actual cash sitting in brokerage accounts, doesn't disappear. It moves. It flows into what economists call safe haven assets. In 2026, this means gold, high-yield government bonds, and hard commodities. This is why during a crash, you'll often see the price of gold spike at the exact same moment the Dow Jones plummets. The wealth isn't gone, it just changed clothes. But the most dangerous part of a crash isn't the paper loss, it's the margin call. In 2026, a huge portion of the market is built on borrowed money. If you used $10,000 of your own money and $10,000 of the bank's money to buy stocks, and the market drops 50%, you haven't just lost your guess. You now owe the bank $10,000 that you no longer have. This is where paper losses become real ruin. The bank doesn't care about money heaven. They want their physical cash back, and they will sell your assets at any price to get it. This forced selling is what turns a dip into a crash. So, why does any of this matter to you? Because most people stay in the market because they feel rich when the numbers go up, and they panic and sell when the numbers go down. When you panic sell at the bottom of a crash, you are the one making the money heaven loss permanent. You are taking a temporary change in expectation and turning it into a permanent loss of purchasing power. The person who buys your stock at the bottom is the one who understands that value is a cycle. They're buying your fear at a discount. The lesson for 2026 is clear. Your net worth on a screen is an illusion. It is a fluctuating representation of human psychology. If you want to survive a crash, you must distinguish between price and value. Price is what you pay. Value is what you get. In a crash, the money doesn't go to a person. It goes back into the void it came from. The only way to win is to own assets that have intrinsic value, regardless of what the guessers on Wall Street think today. Whether it's a profitable business, a plot of land, or a stash of gold, real wealth is what remains when the illusion of the market evaporates. Don't be the person wondering where the money went. Be the person who knows it never was there, and prepare accordingly.